I want to welcome everybody to our second newly branded Better Investor webinar. Thanks for joining us and hope everyone's doing well. I think as many of you know, our goal with these quarterly webinars is to help educate our clients and friends on current events and how they impact our thought process. And then of course, you personally. Our end goal is for you to feel more confident in the decisions that we're making together and ultimately for you to feel like you walk away a better investor. So as usual, I'm going to start off today reviewing market and economic trends. And then for the second half, I'm going to be joined by our wealth planner, Brian Standing. And we're going to get into some planning strategies that individuals can consider to actually take advantage of some of the volatility that we're seeing in markets today. So a quick reminder is that if you have any questions, there's a Q&A icon at the bottom of your screen. And so go ahead and put those in as we go through, and then hopefully we'll be able to get to those at the end. So let's go ahead and get started. So we began last quarter's webinar with the same question. How do we handle increasing uncertainty? It feels like a lifetime ago, but the first quarter of this year was tough, with investors facing major risks from inflation and geopolitical crises. The second quarter only saw further increases in volatility. And now what we've got is basically every possible expert or talking head going on TV and forecasting whether there's going to be a recession and how bad it might be. So it seems like a good time to remind investors of this quote from legendary and contrarian investor Bob Farrell: when all the experts and forecasts agree, something else is going to happen. So it's a good reminder. There are a lot of professionals and supposed experts out there trying to tell investors how current events are going to play out, but it is incredibly difficult to predict with accuracy how the economy and markets will move. Today, we're going to take a look at traditional asset classes and how they've been struggling so far this year. We get this question a lot as to whether or not a recession is coming, so we'll take a look at some of the warning signals and also the Federal Reserve's role. And then lastly, we'll spend some time on different potential scenarios and the range of potential economic and market outcomes. The punchline to all of this is that there is, of course, a lot of uncertainty out there, but we don't actually have to predict or guess the exact outcome to invest intelligently. We can and have been building resilient portfolios that should be able to weather a wide range of potential outcomes for the economy and the markets. All right, so as we usually do, let's take a look at asset class performance for the first half of this year. As most of you are probably aware, it's been pretty ugly 6 months for stocks. So you can see on the left, US, you've got the US down anywhere from 20, 23.5 in that range. International stocks down in the 18 to 19% range. Again, people are hearing that in the headlines. I think the bigger surprise for a lot of investors has been bonds. So you can see core bonds, US bonds here, down 10.5% almost. And then even the supposedly ultra-conservative, super short-term government bonds down 3%. Commodities are still the star, up 18%, though they actually pulled back and had negative performance in the second quarter following just a huge Q1. So our portfolios are generally holding up much better than what's shown in these indices. We're underweight stocks across the board, but I think just as important, we're meaningfully underweight traditional bonds as well. For some time now, traditional bonds have really felt like ticking time bombs, with investors accepting like low coupon payments, but then all of this potential downside risk. So we're going to get into this in a little more detail in the coming slides. First, let's look at how traditional portfolios have performed. You may have heard the term a 60-40 portfolio. It's a reflection of how a lot of investors position themselves with a portfolio that's split 60% in stocks, typically US stocks, and 40% in bonds. So what this chart shows is the yearly return on that 60-40 portfolio going back to the 70s. And down here at the bottom, you can see the first 6 months of this year down 16% for the 60-40 portfolio. There's only one full calendar year on this chart that's worse than that, back in 2008. But otherwise, this has just been a really tough period of time for this traditional asset mix. So why is it doing so poorly over the first 6 months? Poor stock performance is a big part of it. But again, the real surprise for investors has been how badly bonds have done. So taking a closer look, sort of zeroing in, let's look at the periods of time for the 60 portfolio when stocks have been negative. So the column on the far left is when the S&P 500 was down for the year. And then you can see the column in the middle with mostly green is how bonds perform during that period of time. So bonds typically up nicely during that period, really acting as a ballast in portfolios when there are challenges. The reason for this is because bonds are often thought of as being flight to safety vehicles. So there's volatility in the stock market, people rush to bonds. You can look at the 2000, 2002 timeframe here. Again, really tough stock performance, but bonds did really well and offset a lot of those losses. Same thing was true in 2008. The market was down almost 40% that year, the stock market, but bonds did so well, it really cushioned the blow. So the 60-40 portfolio was only down about 20%. The challenge is that the last several years, this has been what people have gotten used to, right? Everyone's used to this idea that bonds are going to buoy the portfolio, but we've been worrying that bonds won't provide the protection to portfolios that they provided in the years past. So traditional investors really would be in for a rude awakening. And again, that's really been the case so far this year. Other than 60-40 portfolios, another popular way for investors to get broad traditional diversification is through target date funds. The funds are sold as being these one-stop diversified portfolios to investors who are saving for retirement and want their allocation to actually get more conservative over time as they approach retirement. These are really popular in 401ks. So if you have a 401k, you might have some target date funds in those. So younger investors, what typically happens is younger investors who have longer time frames before they retire, they'll pick a more aggressive allocation that has more stocks, and then older investors who are getting closer to retirement will pick a more conservative target date. Vanguard is by far the largest asset manager in this diversified target date fund space. So let's take a look at how their strategies have fared during this period. So starting with one of the more aggressive ones. So this is a Vanguard 2050 fund. So somebody who's looking to retire in, let's say, approximately 30 years. So theoretically, someone young who's got a long time before retirement. And the portfolio is positioned accordingly, 90% stocks, about 10% bonds. And you can see that for the first 6 months, down about 20%. Something maybe in the middle, people who aren't quite ready to retire yet, but they're getting a little bit closer. The 2035 fund has about 80% stocks, 20% bonds. You can see down 17.5% for this first 6 months. And then the more conservative portfolio, the Vanguard 2020, theoretically, even for somebody who is already retired, has about 56.5% in stocks, the rest in bonds. And that portfolio was down almost 14%. So you can really see from this that there was nowhere to hide in traditional assets. It's not all that surprising that the aggressive portfolios did poorly, but the conservative ones are struggling as well. The reason that our portfolios have held up so much better than what's shown here is because we're really passionate about truly diversifying into other assets. They're going to be more resilient during times like these. So let's spend just a little bit of time talking about bond performance, because while stocks get the most attention, bonds are largely misunderstood by investors. In early 2021, a little bit over a year ago, our webinar actually focused on bonds and the risks of rising interest rates. We had concerns then that interest rates would rise and that bond performance would be challenged as a result. It felt a little bit lonely at the time making these predictions because interest rates had stayed low for so long and the investment industry at large had just sort of collectively turned a blind eye to these kinds of risks. Given that we've finally seen a meaningful upward move in interest rates, we thought it would be worth briefly revisiting why rising rates are such a big risk for bond performance. So to start, the first half of this year has provided a rather painful illustration of how rising rates or yields are bad for bond performance. So let's just look at that for some kind of broad indices. You can see the moves here, interest rates up, call it about 100% for some of these major groups. So corporate bonds from 2.6 to 5.1, 10-year treasury from 1.5 to 3, the 30-year from 1.9 to 3.2. So big percentage moves up in the yields of these bond indices. And so the performance consequently has been really tough. So corporate bonds down 14.5, 10-year treasury down 12, and then the 30-year down over 23%. So let's look at an example to better understand why rising interest rates impact bond prices the way they do. Let's say that today we go out and we invest in Bond A. So we're going to lend $1,000 to Solid Corp for 10 years at a 2% fixed interest rate. And so for that, the math works out, we're going to make 20 bucks a year and we're going to have $200 at the end of the 10 years. But then let's say that day 2, tomorrow, interest rates rise by 1%. So now you could go lend to Solid Corp for 10 years at a 3% interest rate. And instead of making 20 bucks a year, make 30 and $300 over that 10-year period. Which bond would you rather own? And of course, the answer is Bond B, where you're going to get meaningfully higher income. So the result of that is that Bond A has to drop meaningfully in price, in this case about 8 to 9%, to be equivalent to Bond B. Right? They're both out there, they're both being traded by investors. The bond that has the lower interest rate drops down to make it equally attractive to the new higher interest rate bond. So Bond A drops in price, but some people would say it's no big deal, that if the price of your bond drops, it's okay, because you're still going to get back your $1,000 or your principal at the end. the 10-year period. But this is really missing the point of where the true risk lies when it comes to bond investments. That drop in price from $1,000 of value, in this case to about 915, is a true loss of over 8% of the value. You're locked in to only making $20 of income per year in a new world where now $30 of annual income has become the new norm. And you have to ask yourself, why is $30 the new norm when it was okay to receive $20 just yesterday? The answer is inflation. Something changed overnight. We're now on day 2. Investors are more concerned about inflation than they were on day 1. Maybe it's new facts or data have appeared to point to the fact that $1,000 being returned to you in 10 years is going to be worth less than it was thought to have been previously. So now an investor needs to be paid more income along the way to compensate them for reduced purchasing power of their dollar 10 years out in the future. So if you're that day 1 investor in bond A and you've locked in your $20 of income instead of the 30 you could have locked in, you've already lost. So it's pretty intuitive how this problem really magnifies with longer terms or maturity dates on your bonds. Imagine instead of 10 years, the term of your bond was 30 years, and you locked in a low interest rate for those 30 years. If inflation picks up, the $1,000 you're going to get back at maturity at the end of the 30 years is going to be worth a whole lot less. So this chart shows the effect of just 2% annual inflation over a 30-year period. And you can see that your dollar is almost cut in half by the end of those 30 years. So back to the previous bond example, if you lend $1,000 to a company, that $1,000 will be returned to you, will be worth $545 in 30 years. What happens if inflation is higher than 2%? So here's what happens at a 4% interest rate, a 4% inflation rate. You can see that your $1,000 is now worth less than $300. This is the definition of inflation. Your dollar today is worth more than your dollar tomorrow. The idea of 4% inflation was a bit out there when we gave this example over a year ago, but given that we now live in a world where inflation just printed at 9%, these numbers now seem downright tame, and the carnage in many of these safe bonds hopefully makes a little more sense. We've gotten some questions from clients as to whether or not it's time to buy bonds, given how much they've dropped in value. And I'd like to say my first response is to be kind of pleased and proud at this sort of contrarian instinct. But my second response is to take a step back and look at interest rates in more of a historical context. So this chart looks at the yield or interest rate available on the 10-year Treasury going back to the 70s. And what you can see is that today, interest rates are still at very low levels compared to recent decades. So bonds are certainly more attractive than they were 6 months ago, and it can make sense to add modestly in certain cases. But before diving in head first, it's important to keep in mind that we're still near historic lows on rates, and bonds still could have more potential downside. So to recap, there's a lot of risk out there, and traditional portfolios are struggling. Our solution, as we highlighted last webinar, has been to build resilient portfolios that we believe can better hold up in the face of these risks. Last time we reviewed specific asset classes and how vulnerable or resilient we thought they'd be when confronted with things like geopolitical and inflation risk. And so in this chart, we looked at it, the idea of a range, right? How vulnerable or resilient is something. So the dark purple, it was indicating asset classes that were more vulnerable to the risks, and the dark blue represented asset classes that should be more resilient. You can see that our conclusion with the traditional portfolio was that it was largely vulnerable to the risks that we're most worried about today. Taking a look at instead a truly diversified portfolio, you can see a lot more blue here, representing those asset classes we feel are more resilient. Notably absent from our diversified portfolio is any dedicated exposure to traditional bonds. We do have some liquid bond mutual funds that are labeled here as niche bonds on the pie chart, but those allocations are with managers who have flexibility to avoid interest rate risk when they don't think it's attractive. They can instead invest in floating rate bonds or structured credit. It's not that these kinds of investments that they're making are without risk, but rather they're not the same interest rate risks that we see plaguing traditional bonds this year. Pre-merger SPACs is another asset class we've highlighted that we can see as a substitute for traditional bonds. With these securities, we're often buying a pool of very short-term treasuries, often at a discount, and pairing that with some potential upside if the stock market does start to rise again. Private lending, though, has been one of our most solid asset classes this year, and it's one of our largest overweights in the portfolio. This is because we favor managers who are looking for strong asset protection when they make their loans. So a good portion of this bucket for us is mortgages on real estate properties. And while we would certainly not say that real estate is going to be completely invulnerable if we hit a recession, when you lend at 60 to 65% of the current value of the property, it creates a pretty big cushion in case things do go wrong. Our industry loves to use benchmarks, and so I guarantee that there are lots of advisors out there today with unhappy clients sitting down reviewing the big losses in their conservative bond portfolios. And these advisors are going to point to the benchmark and say how there was nothing to be done because, see, the broad bond market was down 10%. We strongly disagree. There are better income options out there if you're willing to do the work to find them. So is a recession imminent? One of the reasons that asset prices are falling today is because investors fear an economic recession. The most common definition of a recession is 2 negative quarters of GDP growth. But in other words, all you're talking about is the economy shrinking as opposed to growing. So let's look at some of the economic indicators to see if we're headed for a recession. So we would say that the warning signs right now for recession are mixed. What you've got is a number of different common indicators that economists look at out there. And a bunch of those indicators are currently flashing, I wouldn't say quite red, more like orange. So you've got manufacturing data slowing and retail sales slowing, housing activity starting to slow. So nothing where it's fallen off a cliff yet, but where it's starting to show some signs of weakening. In contrast, you've got a pretty strong labor market. So labor market too, showing some signs of slowing, but overall still really strong. It's pretty uncommon. It's right before on the brink of a recession to see a labor market that's quite this strong. Switching back the other way again. So you've got consumer sentiment that's at multi-decade lows. So why is consumer sentiment important? It's because the consumer spending accounts for about 2/3 of economic growth. And today people are worried. And why are they worried? They're worried because of inflation. When you normally have in recessionary environments, when you're going into it, you actually normally have periods where the Federal Reserve, our government, is lowering interest rates to try and boost the economy to stimulate it. But what you've got today is you've got rising interest rates that are there to combat inflation. So instead of, again, supporting the economy with dropping rates, you have the reverse going on as well. And that's potentially the largest factor that could push us into recession. Quick recap of how interest rates drive behavior. This example looks at how businesses behave in the face of low versus high rates. Let's say we've got a lemonade company. It's a hot day, so it sounds pretty good right now. If you've got this small business and you have low interest rates, you are in expansion mode. So you're going to go out, maybe you do a couple food trucks, you hire some more people, but like it's cheap to borrow, so you're in growth mode. In contrast, when interest rates go up and they're high, borrowing is expensive. So instead of going out and expanding, hiring more people, maybe you keep your lemonade stand on the corner instead of buying that food truck. You don't hire as many people. And part of that's because consumers are spending less. So your revenue might go down and you're sort of protecting against that, waiting to see what might happen. So higher rates definitely slow down the economy. So why would the Fed keep raising rates if the economy is already slowing? Aren't they concerned about going too far and causing a deep recession? Again, the answer is inflation. Interest rates are the Fed's tool for combating inflation. In the last 8 bear markets we've had since the late 80s, the Fed has proactively cut interest rates to try and stimulate the economy or mitigate the effects of recession. But today, all indications are that inflation is the Fed's top priority. So a couple quotes that came out recently from Fed governors. We're going to get inflation down. That means we're going to be aggressive on rate hikes, and we may have to take the risk of causing some economic damage. Then from the Fed Chair Jerome Powell, he said that the Fed's commitment to bringing down inflation is, quote, unconditional. So the Fed's been very vocal that inflation is their top priority right now, not preserving the economy. When you look at this chart, it quickly becomes apparent why the Fed has to take this approach. The chart shows interest rates as compared to inflation going back several decades. What you can see is the blue line is short-term interest rates, or the Fed funds rate, while the white line is inflation. And whereas actually historically the two have typically tracked pretty closely together in the past, today inflation is way ahead of the Fed funds rate. So this is why the Fed has to raise rates quickly. They're behind the curve and they're scrambling to play catch up, even if it causes a recession. For a long time, we've had concerns that government policies of extremely low interest rates and money printing were ultimately going to put these kinds of inflationary pressures on the economy. Since 2008, the Fed has treated the economy like we've been in a constant emergency. And by the way, in 2008 we were, but then following that, rates have just stayed at basically zero, and we've had successive rounds of money printing and economic stimulus. We've been critical of these policies because we felt they were short-sighted and a recipe to ultimately increase inflation to dangerous levels. Then COVID hit and government stimulus just went into absolute hyperdrive. Well, the concerns that we've had have been borne out. Some people were surprised at the recent jump in inflation. And actually, in one way, that's understandable because it's been so long since there have been consequences to these policies. But this is, again, something we've been concerned about for some time. And last year, when inflation started ticking up in the wake of the COVID spending, it felt like this was really the impetus for higher inflation. So all that transitory talk back then didn't really make a lot of sense. All right, we're going to look at a couple scenarios. So before that, if we could start with a quick poll, Clarice, if you could put the poll up. All right, and what I'm curious about is which of these risks are you more concerned about? Are you concerned about a recession? Are you more concerned about inflation? Or would you say both? I'll give everyone just a minute to answer. I think we've got to get a Jeopardy clock going next time. Okay, can we get the results, please? All right, so about 16% recession, about 35% inflation, and about half said both. Thank you. Well, if you were in the both camp, then you and the Fed have a lot in common. So the Federal Reserve has a dual mandate, and their dual mandate is maximum employment and stable prices. So maximum employment, in other words, just keeping unemployment low or keeping the economy strong, so not having recessions. And then stable prices refers to consumer prices of goods and services, so not asset prices like the stock market. So the latter is something of an unspoken third mandate that we can touch on in a bit. So essentially, the Fed is supposed to be worried about recessions and inflation. So this is the Federal Reserve's perfect bullseye target. On the vertical axis, you've got inflation, and on the horizontal axis, you've got the unemployment rate. So this bullseye represents inflation at around 2% and then an unemployment rate in the 4% range. This is where the economy's been hovering for years now with low inflation and low unemployment. Again, this begs the question of why interest rates have been held at emergency low levels, but I promise I'll restrain myself from rehashing that again. In recent months, this is how things have shifted. So unemployment actually has gone down a little bit, indicating a very strong labor market, but inflation has jumped up. This shows 8, actually the most recent print was actually 9%. Now the question is, what's the path forward? There are a countless number of scenarios on how this can play out, but we're going to try to simplify things and show you how we think about the risks and how we position portfolios accordingly. So scenario number 1, the Goldilocks scenario. Not too hot, not too cold. So in this scenario, we do get the Fed raising rates modestly. Inflation comes down pretty quickly, and then unemployment stays low. So basically right back down to that target where the Fed was. And from here, the market takes off again. The market's happy. Things are under control. Again, we get back to where we have been. Everything's fine. This scenario sounds great. I vote for this scenario, by the way. The only trouble with it is that it's actually never really happened before. So historically, a recession has followed almost every meaningful Fed rate hiking cycle. The Fed getting things just right and the economy responding perfectly is quite a tall order. All right, so let's look at scenario number 2, the Fed overshoots. So in previous periods of high inflation, like the 70s, it took high interest rates to get inflation under control. So what happens if the Fed hikes interest rates too much in the name of controlling inflation? So in this kind of scenario, what you would get is you get the Fed raises rates meaningfully to combat inflation. The economy goes into a recession and unemployment picks up. So the scale here isn't perfect actually, because 5% unemployment where it is wouldn't be so bad. But the concept being essentially that they do get inflation under control, but they cause potentially a reasonably deep recession when that happens. So again, ways off from their target. Maybe they get the stable price piece of their target, back in line. But from a recession, controlling the economy, keeping employment high standpoint, they would then be in not a great position. The other result would be this would probably be a pretty nasty bear market for stocks. And again, this is the scenario that markets are worried about. However, it's important to keep in mind that not all recessions are evil and they're not to be avoided at all costs. There are actually even benefits to a recession. And so just to go through a couple of them, one of the main ones that we think about is just correcting the misallocation of capital that's happened. And so what do we mean by this? During normal economic cycles, less productive companies typically go out of business during recessions. And then all the resources that were being spent on those failed companies, things like capital investment and labor, they can be reallocated to the surviving companies, making those companies stronger and more productive. So lower interest rates have made it easier for companies to stay in business, whether they should or not. If a recession occurs and these weaker companies go out of business, then all that capital they were using up can be reallocated for the rest of the economy and make it stronger. A couple other benefits, just increasing efficiencies, reducing costs. Companies manage to be very resilient and come up with a lot of really creative ideas or technologies, when they're faced with challenges in an economy. Instilling a savings mindset that hasn't been there for some time. Reducing debt levels. Taming inflation. Again, that's a big one. That's the Fed's goal with this. And then setting the stage for a new growth cycle. So again, when we let the economy experience a recession and go through that cleansing, we've historically come out stronger on the other side, and it's set us up for attractive growth and prosperity. It's just been some time since we've experienced a real cleansing and the robust aftergrowth that can go along with that. So this brings us to our scenario number 3, the Fed chickens out. So the Fed doesn't officially focus on asset prices, but it's definitely something they look at. And it's easier said than done to let the system cleanse with the recession. So our concern is actually that the Fed won't have the gumption to take inflation all the way back down to 2%. They'll chicken out when they see a recession start or the stock market tank, and they'll panic and reverse course before we've reached their real inflation target. So what could this look like? You get the Fed raising rates, but inflation only comes down by a little bit. The stock market continues to correct, and then Fed panics and then lowers rates prior to actually dampening inflation. Little reversal there. So this is in effect, the consequence of this third scenario is in effect kicking the can yet again. And the challenge is that I think we really don't know what the ultimate ramifications would be for investments. Again, we'll be way off from the target here, but I'd say that most people would argue that this would be good for stocks and bonds because it'll be a return to easy money policies that we've had for the last decade. And easy money has been wonderful for asset prices for quite some time. This is probably even the likely scenario over the short term, that the market would be relieved that the Fed isn't going to choke the economy. Our concern is that this type of move could spell doom for the Fed's credibility. They'd essentially be tossing the stable price mandate out the window in favor of supporting asset prices. This has consequences, and it's tough to know how they play out. For example, the Fed accepted a go-forward inflation rate closer to 5%. What investor is going to continue lending to the US government at the current 3% rate? Inflation is also not great for stocks, and its companies face pressures on their cost and profit margins. So once the market gets wise to some of these consequences, it could be tough on asset prices. So it's just a bit of an unknown how exactly things would play out. With so much uncertainty out there, what can investors do to protect themselves? So I just spent some time talking about all these different scenarios that investors face, and I think it's important to be aware of those potential outcomes and risks. So in that sense, it's, I think, a really worthwhile exercise. In general, though, the investment industry wastes so much energy trying to analyze all the various outcomes and probability on a range of scenarios. But at the end of the day, investors can't control the Fed. They can't control markets. What they can control is how their portfolios are positioned. They can choose to create resilient portfolios that can withstand periods of volatility. We already spent some time on this pie chart with the various bond substitutes that we use. And look, even though our targets are quite low, we do own some stocks in case the Goldilocks scenario happens. Or more likely, in our opinion, the Fed reverses course and markets celebrate. But those stocks are combined with a diversified mix of strategies we think of as being more resilient. These resilient strategies can include things like equipment leasing, where investors can target high single-digit returns on loans backed by equipment that's essential to a business. We strongly favor asset-based lending because if the economy does hit a rough patch, there are assets backing our loans, even if the borrowing company goes out of business. Real estate equity can also be a resilient asset if it's positioned properly. As housing has surged in recent years, we've avoided the luxury end of things and focused on essential housing with groups that build more affordable apartments in markets where there's meaningful demographic-driven demand. Real estate is certainly not immune from rising interest rates, but as much as possible, we see our managers locking in fixed rate debt and investing in the types of properties that could see meaningful rent increases if inflation continues to rise. These opportunities are hard to find. They take a lot of our investment team's time and energy, and this is really why most other firms don't invest this way. But it really feels worthwhile in this type of challenging environment where we can see how our approach pays off by protecting our clients. So other than creating resilient portfolios, what else can we control during periods of market uncertainty? We're going to switch gears now, and I'd like to welcome Brian Standing to the conversation. As a wealth planner on the Morton team, Brian has something of a different take, I think, on market volatility and how it can create attractive planning opportunities for clients. A couple fun disclosures. I'll go ahead and stop sharing. Hey, Brian.
Good morning, everyone.
All right, well, glad to have you back. Let's get right to it. So while, again, we're not excited that asset valuations are declining over the first 6 months of the year, what kind of planning opportunities could this present for clients?
Sure. I just want to note, first off, that we're shifting from market bad to death and taxes. So thanks, everyone, on this webinar for sticking with us here. Obviously, we don't want, valuations to go down. But one of the things we always talk about in estate planning is that changes in asset valuations should call for a review of your planning that you have. We hope that's for the better, but when asset values are going down, it's a reasonable time to talk about estate tax planning, among other things. And so, as a reminder, estate tax planning involves taking steps to reduce or eliminate the potential tax that's due when someone passes away.
Can you remind us where we're at right now on estate taxes? There's, I know, been a lot of changes. So when is an estate large enough to be subject to estate tax, and how much do they have to pay?
Sure. It's still pretty generous, at least historically, which is to say that we have $12 million of assets per person before any estate tax is due. Now, that tax is pretty rough if you do pay it, because it's due within 9 months, and it's 40% of all of the value above that 12 million per person. And then it's important to keep in mind that that's not our exemption indefinitely. We're under a law right now where in about, a little over 3 years, that number will be cut in half. So, call it 6 million. With inflation, it'll be a little higher, but effectively it will be 6 million per person, 12 million per couple.
So fundamentally, why is it attractive to gift assets when they're down in value? Like, what does that look like from an estate standpoint?
Yeah, so the easiest way to think about the estate tax exemption is really that it's just a total transfer exemption. This is the amount you can give someone else, whether you're living or at your death, or some combination of those things, the amount that you're allowed to give before they charge you money. And so when you make a gift during your lifetime, you're getting assets out of your estate, but you are using part of that 12 million that's available. So what's the difference? Well, if we do it now, while assets are lower, we're utilizing less of the exemption in order to push that asset out of the estate. And then, of course, over time, if that value recovers, that appreciation is no longer in your estate either. We've already moved it out, and so it can grow to any amount, and we don't have to worry about paying estate tax on it later.
So if somebody had, for example, $1 million stock portfolio that they want to gift, now it's worth 800,000. So you're only using 800,000 of your exemption instead of the million if you gift that now.
Exactly right. And then, with certain assets, you may even take discounts on top of that. And we don't have to get into that today, but it can be really attractive to have an asset that's low in value, and we take a discount on the gift value. And so we're really moving a lot of assets out for a low estate tax valuation.
So as a little bit of a review, what's the catch to this? Should everybody with a sizable estate just go around gifting assets away just because the values are down?
If they're gifting them to me, sure, we'll go for it. Otherwise, important caveats, considerations. We talked a little bit about these in a prior webinar, but most importantly, we need to know that we can't separate the economic benefits from the asset. In other words, if you give something away, you give away its income as well. A lot of people say, well, if I just change the title, I don't own it anymore. And I say, well, but the income doesn't come back to you. And like, oh no, I want that. I still need to live off of that. And so we need to be really clear about, can we afford to do this? Can we live on other assets? Do we need them now or in the future? And only after doing that analysis should we feel comfortable giving assets away.
We previously discussed certain types of tax planning that were more effective when interest rates were low. So as rates increase, are there specific strategies that come back into favor?
Yeah, a little bit. I mean, obviously, as you explained, the rates aren't high by any means, but they're higher. And so there are strategies that It's not that they're not effective in general, they are, but they become more effective or more powerful when the rates go up. And so one that a lot of our clients might know is a charitable remainder trust. Simply stated, this is placing an asset in a trust, maybe receiving income from it for life, and then when you're gone, that asset, whatever is left, passes to a charity. And so there are many reasons to do this under any circumstances. Commonly, that would be an appreciated asset. You don't want to pay capital gain on it when you sell it. So you place it in this trust, you sell it without capital gain, and then you can live off of the income that it generates. The reason that the interest rate matters is that on top of those benefits, you actually get a deduction right up front. When you put the thing into the charitable remainder trust, you can take an income tax deduction against all of your income. And that deduction goes up when the interest rates are higher. So it's just a little added benefit to that strategy.
What about clients who are more focused on getting assets to their kids, maybe instead of to a charity?
So there's a kind of a curious strategy, I would call it, that is better in a high interest rate environment, and that's having to do with your residence. So this is a qualified personal residence trust. And so what's interesting about this is you get to put your home in a trust. You're basically giving it away, your residence, but you're reserving the right to live there for some number of years. So why would we do that? Well, when someone receives an asset, but there's no cash flow, right? You're not paying rent, you've reserved your right to live there. The value of that asset goes down. And so now with higher interest rates, that discount we get is much higher. So you can effectively give your home away, of course, only if you want to, at a much greater discount to move it out of your estate at a lower value.
So these all sound really interesting. I guess, what about people though who aren't as concerned with estate taxes? Maybe they're below the threshold or it's not right for them. Should they be reviewing their regular estate planning documents anyway?
Absolutely. Obviously, as an estate planning attorney by trade, I think it's always a good time to review your estate plan. But I can give some examples of how valuations might impact typical estate planning. So certain plans might call for specific distributions that sort of come off the top when our clients pass away, individuals, organizations, before the remainder goes to children, for example. And as the estate value goes down, that amount that's redirected to non-children goes up as a part of your estate. And so we would want to revisit those gifts and just make sure that that still aligns with your wishes. Sometimes we have plans where we have specific assets and we want to leave them to different beneficiaries, maybe so they're not partners or someone's involved in a business or who knows. And as valuation changes, what used to be sort of an equitable plan among your beneficiaries maybe isn't as fair. And so we need to look at those assets to see how that works. And then maybe one other example would be, often we have beneficiaries where we're intending to support them for life. And so we have done a calculation, okay, how much do we need to set aside for this beneficiary to last their lifetime, taking into account investment returns and inflation. And that amount may or may not be enough now. And so we need to come back to those kinds of distributions and see if they still work.
Okay, great. Thank you. Those are some very, I think, interesting, helpful points to consider. Maybe we're going to go ahead and take a few questions. Go ahead and see here we've got. So one question was, in what scenario would we increase our allocations to stocks or bonds? I don't think there's an exact, we tend not to look at it like, oh, the market's down this percent and that's your buy trigger. I think it depends on a lot of things. But we're looking at, for certain clients, stocks when they were down 20-ish%, it started to trip certain thresholds where it had us look at, do you start nibbling around the bottom, probably not buying up to target, but start to buy. I think if the markets continue to fall, it'll be more portfolio specific for our clients who have longer timeframes or more aggressive. We'd probably start buying sooner on stocks, starting to rebalance, back to targets. In the bond space, look, we're really happy with our bond alternatives. So I think that it's going to take interest rates being meaningfully higher before we move it there. But the flip side is, if that happens, right, we're getting on private lending, we're making 8-9% type targets. If all of a sudden muni bonds, at a reasonable, duration, how long term they were were yielding, 5-6%, that would be a very attractive alternative, right? We would either be looking for the rates on the private lending to rise meaningfully to keep that more attractive, or we'd be saying, hey, we should start trimming that and moving it over to the municipal bond. So look, I personally look forward to the day when I'm excited about stocks and bonds. And as I mentioned previously, it's a lot less work to kind of do and track this stuff. So we're definitely watching it. And I think even looking for pockets of opportunity or potential options to be tactical, if maybe broad markets aren't attractive yet, but there's sort of a one-off opportunity, we're definitely on the hunt for those as well. Brian, there is a question here about estate planning and retirement plans, saying basically what should you do if you have a big retirement plan from an estate standpoint?
Those are challenging assets for us in estate planning because we can't gift retirement plans, right? We're sort of stuck with them. And from an estate tax perspective, we have this asset where we will pay estate tax on its full fair market value, whatever the balance of your plan is at your passing. But your beneficiaries don't actually receive all of that because they will pay income tax when they make withdrawals. So we're paying estate tax on the full value, beneficiaries are getting some percentage of that. And so there's a potential for looking at conversions. There are pros and cons there, but doing a Roth conversion while valuations are lower, right? We'll pay fewer taxes today during that conversion. And now we have an asset that, while still subject to estate tax, isn't going to be taxed later to your children. So it's a preferable way to inherit retirement plan monies would be in a Roth IRA.
Makes sense. One question we got here was about I-bonds and our opinion on I-bonds. So I-bonds are essentially government-backed bonds that have a very high interest rate and can be very attractive. The challenge with I-bonds is the size. You're limited. I need like my financial planning team on, they'll know this answer off the top of their head. I think it's something like 10 or 15 grand a year that you're limited to. So while if I could buy hundreds of thousands of dollars of that, I think it'd be very attractive, but it's a very small amount, especially for a lot of our clients on a percentage basis that they'd be limited to. And the logistics for buying them and going through the process are nothing. So like them, just do they move the needle, I think is the main question. All right, follow-up question here on stocks and sort of when they're attractive. I guess the question is, how are valuations on stocks more attractive now? And obviously we talk a lot about, or have talked in the past a lot about valuations. The answer is yes. Like if you look at prices, obviously, if you're down 20% relative to the same earnings or the same cash flows a company has, obviously that's a more attractive place to be from a buy standpoint. A couple of things. One is we're still not, I would say, cheap by historical standards, though obviously, again, prices coming down, you're getting closer. Now the thing to watch is the E in the price to earnings, right? The earnings and whether or not earnings hold up especially if we hit a recession. So will we be in an environment where earnings take a big hit as well, and then that would make evaluations more expensive again? So the answer is short term, yeah, there looks like from a number standpoint where things are getting more attractive, but we have to kind of see how some of this plays out from a recession standpoint. If valuations are going to get to be in the real screaming buy territory. All right, a couple more questions here. One is, which types of equities are best in an inflationary environment? Are different equities suitable for recessionary periods? And the answer is yes. I mean, historically, there have definitely been some that have held up better. So if you get things like consumer staples, right, stuff that people have to keep buying, historically, healthcare has been less tied to exactly what's happening in the economy. So things like that definitely can do better than others. And one thing, for example, that we've had kind of a tilt or an overweight to dividend paying stocks and more value kinds of companies, primarily not because we were sort of calling for an immediate recession, more just because growth companies, technology and stuff has done so well for so long that the values on those had gotten very high. And so we had tilted more toward value companies. And so far this year, that is the case. Value stocks are holding up well during this period of volatility, versus growth stocks. It's certainly not like a place to hide, though. I mean, I think value stocks are down. They're still down double digit. So it's not like you're going to make money necessarily in this kind of environment, because I don't think value stocks are necessarily super cheap either. They're just better than growth in a lot of ways. But I'd say yes, the answer is yes, and we're tilted toward things that we think should hold up better or be a little more resilient during challenging environments. All right, I got another one here about real estate, asking, how we think about real estate being vulnerable to interest rates. Real estate definitely vulnerable to interest rates in the sense that, everything in real estate is sort of priced off of interest rates. And as borrowing costs rise on real estate, in theory, prices should come down, right? You can't, if you're making, let's say a 5% yield on a property, but you have to borrow at 6%, that math doesn't work. So in theory, the price has to come down to make that an attractive purchase for someone. The one caveat to that is, as I mentioned briefly, it is rents, or income from properties. Real estate can be attractive in inflationary environments if you've got the pricing power to raise rents. And so even though your borrowing costs are maybe going up, if your income on the property is going up as well, that can sort of keep up with inflation. The question is which one's going up faster. So if you're with managers in real estate who are thoughtful to all of this and sort of concerned, again, if they can fix the rates on their debt at these crazy low levels before, they did it, a lot of our managers. And so they're in good shape. Hopefully their rents are going to be increasing and their debt costs are not for some period of time. But certainly interest rates will affect real estate. I'd say different sectors or different types of properties, some more than others. All right, another question here about commodities. So does Morton invest in commodities? So the answer is yes. We have two different main sleeves. One is, I think everyone knows, we've had a gold allocation for some time, which I don't really consider quite the same as commodities broadly, though it's often lumped into that bucket. We really hold it more as a hedge against monetary debasement or all this money printing that's going on. And so gold did real well in the first quarter, and then it kind of had a pullback where I think it was basically flat or down small, through the second quarter. I think that one's a bit more of a longer time frame. We'll see how some of these different things play out with interest rates. I think a lot of the dollar strength is more why gold hasn't taken off. Actually, in other currencies, like versus the euro or other currencies, gold has performed much more strongly in this environment. So ultimately, I'm still comfortable with that. I think it's a good place to be from a hedging perspective, mostly because you're talking about, if you think about your net worth, the vast majority of it is in the US dollar. So having something that's a little bit different in there, I think makes sense. We recently started adding more of a diversified commodities bucket, and just thinking through, I guess cyclically, I think there's a lot of pressure on commodity prices, whether it's food or energy, different kinds of things, even in the ESG space, for certain alternative energy kinds of companies, there's going to be a lot of demand, and there's been a real lack of spending in that space. So we have started adding small allocations to that as well in our portfolios. All right. Does California follow the rest of the country with its appeal in general, and so many wealthy people not affected by inflation, recession? I think the question's asking, is California going to be not as impacted by inflation and recession because of the wealth we have here? Look, I mean, wealthy people, I guess it depends how much they spend. I've met wealthy people who, they have a lot of assets, but they're spending them down at a pretty good clip. I think if people have a good cushion, obviously they're going to be a lot more immune. So that's certainly possible, but we've got a lot of poverty here as well, or a lot of people who are, not in that top 1%. So I don't know that I would think of California as being immune from recession, though, again, some of those trends certainly matter in these things. All right. Okay, great. Well, I think we've gotten to all the questions. So I want to thank everybody for listening and appreciate the participation as well. And if there were any follow-ups you had or any questions, feel free to reach out to your Morton Wealth advisor, and hope everyone has a great day.